Good afternoon, everyone. Nick Martin is my name from BDO, and together with my colleague Tony Schiavello, we're going to lead a discussion today entitled Business Survival in the New Normal. We're going to cover a range of issues, but I think it's ironic that we're holding this session only hours after Virgin Airlines has announced that they've gone into administration. And as I read the media this morning, it's interesting to reflect on Virgin had in the order of $700 or $800 million of cash reserves. And notwithstanding what seems like an extraordinary amount of money, they've made the decision, after exploring a range of options, to appoint administrators, recognising that their cash burn rate is significant. To today's session, we've had a lot of commentary, we've read about it in the paper, we've seen it on the evening news in and around the various stimulus packages. We're not going to talk to that today. We'll take that as read. We might touch on it from time to time, but today is really about talking about how do we manage our businesses on the way through this crisis and preparing ourselves in the best way possible so that we can pop out the other side. We've developed some themes internally at BDO. We've talked about survive, strive, and thrive. Survive is really in and around preparing in the first 2 or 3 weeks for what this thing looks like, identifying the crisis, preparing for it. But now we want to talk about how do we need to shift our thinking so we can manage our way through the next month, 2 months, 3 months, 6 months, whatever that's going to be. So we do have a survey at the end of the webinar. We'd ask you to complete that at the time, but I might throw to my colleague Tony Schiavello, who's going to lead the conversation through the importance of cash flow planning, cash flow forecasting, and some of the tools and strategies that businesses can use, both in the lead up to where we've got to today, but also over the next month. So Tony, I might throw to you.
Thank you, Nick, for that introduction. So I will be talking today specifically around cash flows and the use of cash flows as an important decision-making tool. And one of the most important things about a cash flow in terms of forecasting the cash runway is understanding how much cash the company has and when that may run out vis-a-vis its ultimate liability and debt requirement. As Nick mentioned in the introduction, whilst you can have significant cash on hand, that always needs to be assessed against the liabilities that you must ultimately pay and the debt inclusive of debt. And so as Virgin was in a position with over $5 billion in debt and 800 million in cash, obviously there was a continuing cash flow issue there. And so appropriate modelling to understand that scenario led that company to a decision that it was in its best interest and potentially best interests of all stakeholders to make a formal appointment. And so we'll go through some of those implications today. So New World Cash Flow Forecast, what does that really mean? If we go to the next slide. So building a cash flow in this new world, what are things to consider? I spoke briefly about cash runway and when knowing when your cash will run out, but cash flow is really a critical aspect of a business. Often you might have heard the term profit is vanity, cash is sanity, and really that saying and proverb is no more true now than probably where it has ever been. Whilst there has been stimulus measures put in place, it's important to understand what the cash implications are of the business, of your business, particularly how COVID-19 may be impacting on debtor collectability or sales pipeline. But it's always important to be aware of your cash outflow. So in terms of recent engagements that we've been involved in, we've assisted clients in building their cash flows. The approach that we typically take is it is a 90-day cash flow. I think in these uncertain times, to project much further beyond that can be a bit arbitrary. but certainly some level of certainty can be baked into a forecast for the next 90 days. You can control a lot more issues in the next 90 days compared to the next 6 months or say a year. And so in building that cash flow, we factor in what are the committed expenses and really segment expenses between what is committed and important and what is not. So committed and important might be salaries, suppliers, stock. So those 3 S's there, they're really expenditure items which most businesses will in some shape or form not be able to flex too strongly. So from that perspective, understanding and baking those in and understanding what can be done to flex those. And then putting discretionary expenditure, highlighting that separately in the cash flow and understanding the ability to defer or delay those payments. Also, assessing that cash flow weekly, very important in terms of decision-making tools, and particularly in this environment where businesses are looking to negotiate with their stakeholders, whether they be landlords, whether they be suppliers, or other stakeholders, or banks for that instance, you're more likely to get a positive reception if you're able to present a well thought out cash flow with sensitivity analysis baked in. So we'll discuss what sensitivity analysis is, but it's effectively the ability to flex assumptions to understand what the impact of pushing debtor days out by an additional 10 days, what does that mean? Does that put the business under additional stress, or is there sufficient headroom to continue to trade? And finally, use of a dashboard, which we'll discuss on the next page, is a very visually impactful way in summarising where your problems might come into effect and developing mitigation strategies. Nick, did you want to add anything on this particular slide?
I think that's good context, Tony. Yeah.
If we go to the next slide, you'll see that we provide there an example of a dashboard. So the dashboard measures, it links into your inputs page where all your assumptions go. This is a visually impactful way in showing people at a glance, does the business have sufficient cash flow to continue to trade? In this example, you can see at the start of the period, there is headroom, but as we move towards the end of the period, that headroom diminishes and close to a nil cash position. So I can see immediately from there, as I move towards the end of the year or to the end of this period, in this example, I really need to focus in on making sure I've got sufficient headroom in those early months to then take me through the latter part of this period to ensure that I can continue to maintain cash positivity. So anyone who sees this, you could use this in your negotiations with a landlord in negotiating a rental reduction or a payment holiday. And then they can clearly see that, well, yes, the business does have an absolute need for that to occur. And so this is a very quick way to then put forward your case, more so than just providing a spreadsheet with numbers that hasn't got any context. In putting the cash flow together, it's important to understand what the latest cash balances are, obviously, but in developing inflows, really, the first thing we recommend is call your debtors. It provides an excellent opportunity to touch base with your customers, understand how they're going, understand whether they will pay on time or whether they are in fact having their own issues. In this environment, it's very easy to delay payments and defer payments. And if you lack contact with your key customers or customers at large, then you're more likely to fall at the bottom of the queue for repayment. And so making sure you keep in touch with those debtors and customers has a twofold impact, and it can be very useful to maintain that dialogue. In terms of cash outflows, I mentioned previously, segment them into critical and non-critical. Non-critical, defer those, seek not to pay those for as long as possible, to the extent that that is an appropriate strategy. And obviously with critical creditors, whether they're landlord, stock, staff, there are other alternatives to either defer, delay, or reduce those payments, whether that's going down to a 4-day week, whether that's looking at pay reductions, whether that's looking at timing of extended terms with stock suppliers and the like. So all of those things should be investigated. And then to wrap up that analysis, a sensitivity analysis to understand and help you understand the impact of what does a delay in debtor collections mean for the business? Can it continue to trade through that sensitivity? Nick?
Yeah, I agree with a lot of that. I think that it's just critical to use the runway. Absolutely critical in those times. Yep.
Mm-hmm. And look, in our experience, and certainly undertaking negotiations on behalf of clients, suppliers and creditors really they appreciate transparency. They appreciate communication. The converse is what they don't appreciate. Not opening a dialogue and just not paying is a wasted opportunity. So we encourage, we certainly recommend and encourage people to maintain that dialogue, particularly in these uncertain trading conditions. The next topic we'll discuss is strategies in stretching cash flow. So some of this will be obvious: cutting costs, accelerating collections to stretch cash. So really it's around reviewing that profit and loss and balance sheet, and identifying what payments can otherwise be deferred or eliminated. Understanding that deferral doesn't mean that the cost and liability disappears. It effectively continues to accumulate and will need repayment in the future. And certainly a cash flow analysis can track that cash requirement in the future to understand what that debt load or liability load is, and whether the company, as it continues to trade through these uncertain times, will have sufficient cash at some point to repay those liabilities. Again, using the Virgin example, whilst the company did receive a number of incentives, whether that's JobKeeper and reduction in excise duty on fuel and the like from the government, it was able to defer liabilities but could not see a cash runway to be able to repay those liabilities at some point in the future. And so that's a really valid test that shouldn't escape everyone on this webinar, that deferral doesn't mean elimination. It will be there and needs to be repaid, and that needs to be factored in to your thinking. Some of the other points there, engaging with suppliers and the like, I've already mentioned some strategies there in terms of how to deal with it. But again, use of a cash flow that can be shared with those stakeholders can lead to a more receptive response and positive response from those suppliers than just going there and asking, oh, business is tough and can I please have a rent holiday or a deferral of payment regime. Nicholas, did you wish to add anything there?
A couple of comments. I think your point is really valid, Tony, that a lot of this stuff is very obvious. But I think that what we've seen is perhaps insufficient rigour and discipline being applied to recognising and changing behaviours. This requires a shift in mindset. And so I'd encourage people to be far more disciplined and far more rigorous when they're thinking about these sorts of things. We're doing some work with landlords and property managers at the moment, and they're asking us the question, how should we be assessing requests from tenants for concessions? And so what we're saying to the landlords is there needs to be a meaningful plan. Cash flow is part of it, but there needs to be a meaningful plan. So we're helping develop the model for the landlords and for the property managers so they can properly assess requests for support from landlords, which obviously have already started. Sorry, requests of landlords, which have already started.
Thank you, Nick. And we perhaps should have mentioned that you've got the ability to ask questions through this seminar. And I see there's a question that's been posed. What program do we use for an integrated dashboard? It's a good question. We use Excel. So Excel will always have a profit and loss, a balance sheet, and a cash flow, which are integrated. We also separate the spreadsheet into an inputs tab. So all of your assumptions are captured on that input sheet. So the viewer can quickly glean, well, do the assumptions make sense? Are they appropriate? But if you ever wanted to change an assumption so that you could work out, well, what's the impact on my cash flow, then there's a central location for that. All of that information then filters up into what we call that dashboard, which you saw on the previous page. And that's effectively a graphical representation of the finer detail of that profit and loss, cash flow, and balance sheet items. We can overlay over the top of that ratios, whether that's quick ratio, debt ratio, interest coverage, and other sorts of things, which are key things that banks look at. But also net asset coverage and security coverage are other things that can be overlaid on that. Perhaps if we move to the next slide. Government support and options available to you. Just quickly on that, I'll just mention very briefly, we've had some queries in the past, particularly on JobKeeper and how does one qualify. Well, broadly, a revenue test of $50 million is evident. If your revenue is under, if your revenue is under $1 billion rather, then your revenue has to fall by 30% for you then to be able to claim JobKeeper assistance. Now, how does one measure 30%? Well, the tax office looks at your GST billables from one period to another to determine whether you do in fact qualify. The important thing to understand is that whilst you may qualify and meet those criteria, the payment of that assistance will not come through until towards the end of May. And so factoring that into any cash flow is an important part. So I'll mention those sorts of things, that whilst government initiatives are and stimulus packages are available, one must understand the delay in receiving those payments, and can the business continue to trade and meet its cash flow requirements in that interim period is an important thing to understand. Nick, did you want to embellish on that point?
I'd make another comment, Mark. I think that, really simplistically, the JobKeeper subsidy is worth about $35,000 a year on an annualised basis. So if an organisation employs 100 people at $100,000 on an average salary, to make the maths easy, the business still has to come up with $65,000 per employee on an annualised basis. And if you've got 100 staff, the business still has to come up with $6.5 million. So I think businesses need to turn their mind to how do you reconfigure your workforce, because the JobKeeper support package, I'm not sure how to what extent it creates or provides real benefit to a business. You've got the cash flow issue that you've just raised, Tony, but I think if you take a step back for a moment, there's still an enormous and onerous liability on businesses if they have to come up with the other 65% of the salary based upon a $35,000 annualised JobKeeper package. So sounds good when you say it quickly, but to what extent are these stimulus packages going to make a meaningful impact for businesses in that SME and family business space?
Look, indeed. So there's a subsidy component to it in an environment where your workforce is stood down and therefore is not working. Then ultimately your employees can continue to benefit from from that and maintain that connection with the employer. Very good. Perhaps we can move on to the next slide.
Okay, thanks, Tony. Before I start on this slide, I made the point before that I think this environment requires a shift in thinking from leadership teams, whether it's the finance function, whether it's operational, whether it's shareholders, whether it's owners. There needs to be a really sharp focus on what really matters. And I think that until we get to these times, leaders can tend to focus on too many things. Now's the time to focus on what really matters. What's going to move the dial, what's going to protect the business. And so with that, there needs to be an increased level of rigor and discipline on focusing on what matters, which includes measuring what matters. And so I'm expecting that many businesses on the call, many of those on the call, will have turned their mind to and prepared a critical plan, a 90-day plan. And on the next slide, I've summarised just 4 or 5 things that I think are essential to that plan. A plan could be a piece of paper, but ultimately, what is important is to understand what are the assumptions which underpin whatever that plan looks like. What's the difference between a worst case and a realistic case? Some industries are experiencing worst case. They've still got all their outgoings, whether it's occupancy or otherwise, and they don't have any revenue. What's the difference between a worst case or a base case and what's realistic? There's a tendency as business owners to be optimistic. Now's the time to be realistic. Introduce the concept of asking dumb questions. Dumb questions help to tease out whether the assumptions which underpin the forecasts are real. I'm always skeptical of a cash flow or a forecast which has been prepared without assumptions. We need to test the assumptions, not the numbers. The numbers will be whatever they are. It's all about the rigor and discipline of testing the underlying assumptions. Tony touched on 90 days. I think it's absolutely right. Beyond that, it's difficult to forecast with any level of certainty. But I think once we get into the rhythm of a forecast, it's important we have a rolling cash flow, but as part of that, that we are measuring our forecast cash with our actual cash. Tony touched on the relevant government support packages, but I just pause and I pose the question, to what extent will that have a meaningful impact on a business? If a business was marginal a month ago, or if a business was a strong business a month ago, to what extent will these government subsidies have a positive impact or a neutral impact on the business? And of course, as we prepare and we implement these management plans, we need to have an eye on the future. What does the new world look like once we get through the next month or 3 months or 6 months and life returns to some level of normality? What's that going to look like? How do we keep an eye on that? And of course, Tony touched on it before, this plan, who's going to read this plan? Obviously, the finance team will have a look at it. The shareholders, the CEO will have a look at it. But it's realistic to expect that any stakeholder that we ask to support our plan by providing some sort of concession, bank, landlord, key suppliers, key customers, we need to be prepared to share our plan with them. We need to bring them into the tent. We need to be fully transparent. And so as we prepare our plan, just have in mind who's going to be reading it. Tony, what thoughts did you have?
Look, I think that's right in terms of having the end user in mind. Can see you place significant importance on different things. So a discussion and negotiation with a bank will be different to a landlord, will be different to a supplier. So from that perspective, it's really the base of the cash flow is there, but that dashboard, in tailoring it to the specific audience, can really assist you in getting the objective that you're trying to getting the objective you're trying to achieve, really. So I think your points are well made, and the output and how it's displayed is also important.
Yep. And so I think to the next slide, I think there's a lot of these points I expect and I hope that businesses will have already addressed. But going back to the Virgin example and the irony, and I don't mean it to be a pun, but the runway, but Virgin identified they had cash at bank, but their cash burn rate meant that their runway was shortened. So with all of that, I expect that many businesses will have looked at how they can accelerate their cash and how they can defer their payments. But what businesses perhaps haven't thought about is, should I be grading my debtors? I've got my A, B and C grade debtors and I've determined them based upon some objective criteria. During this time, we should be thinking about who are the customers that we want when we pop out the other side, and conversely, who are the customers that we don't want or we can do without because they don't produce significant contribution, they always take a lot of management time, they're always complaining, they always want discounts, whatever that might be. You can have a think about how do we bundle up our C grade debtors who are typically going to be longer dated. How can we bundle all them up and sell them as a portfolio to a purchaser of that debt? They might give us 10 or 20 or 30 or 40 cents the dollar for those debtors, gives us instant cash and frees us up to focus on those debtors that really constitute the future of the business. You see work in progress in a balance sheet. What's its real value? And by that I mean, that's only a gross value. It's going to take us time and cost us money to convert work in progress into finished goods and into cash. And if we start to think about how do we efficiently identify and manage our work in progress, it's also going to inform changes that we can make to our workforce. There's no point in us spending time and money on work in progress which has a significant cost to complete, but only a small profit based upon the work undertaken to date. So a proper analysis of work in progress is important. Many of us have seen inventory which has been sitting on the shelf for 6 months or 12 months, converted to cash. If it hasn't been used in the last season, it's tying up working capital. We need cash because we need to build a runway. With a runway, we've got flexibility for planning. What plant do we have that we don't use? We can sell the plant if it's surplus, but we need to recognise that it's probably subject to security held by the bank, but perhaps we can do a deal with the bank where we sell surplus plant and we share in the proceeds. We can retain some cash for our working capital and we can pay down some debt. We need to just be alive to that. I think on the creditor side or the payment side, it's really important to understand your leverage. Do you have leverage? Is it real? Is it perceived? And therefore, to what extent can we push our creditors? The stimulus package has talked about some taxation concessions, but I think that I'm not sure that it provides a great material benefit. I mean, I think many businesses were not going to pay their taxes for the next 3 months or 6 months. Important that you lodge so that you're mitigating your risk against personal exposure to tax office. But if it's not a critical supplier, and it's important to understand the concept of a critical supplier, we can push them off for months and months. The laws have been changed so that creditors can no longer petition the winding up of a company unless it's for an amount in excess of $20,000 and the debt's been outstanding for 6 months. So we can really stretch our creditors a long way. We've been given some great tools. We can push them out a long way. So now's the time to do that, but I'd encourage people to think about what is truly critical as opposed to what's important as opposed to discretionary. And that's just to round out that conversation. Whatever's discretionary, cut it. Capital works, can we push them off? And dividends, I think it's important that stakeholders like landlords, employees, banks see that the business is doing whatever they can to stop cash leakage. And they're just 3 examples. Tony?
Look, I think, I agree with those comments, and particularly in retail. Retail is one of the hardest hit sectors. It was already had some headwinds prior to the COVID-19 proliferation, but more so now with physical stores being closed for some time. At many retailers, how do they determine the best way to continue to trade? And we've got a live example at the moment where we're assisting a retail client, and a lot of the strategies that you mentioned, Nick, are absolutely ones that we're implementing. Take that last season's stock or towards the end of this season's stock and start to really go on sale, liquidate that stock, get cash in there so that you can prepare the business for the next season's worth of stock when stores open up again. And there are specific providers of services out there that will buy that stock and look to sell that stock in the future through various outlets to give liquidity to clients. And so it's not just go on sale. There are professional firms out there who do buy stock and then look to take the risk in terms of realising that over time. So yeah, really important.
Well, I think you've got to remember, sometimes we're a debtor, sometimes we're a creditor. How do we maximise which hat we're wearing at a point in time? If we're a provider of services or goods, it would be good for us to receive a deposit before we undertake it. Similarly, if we're placing an order for goods, we don't want to have to provide a deposit because that hurts our cash flow. So just being flexible. To the next slide.
Just on that, Nick, I suppose one further comment I'd make is building a runway to buy time. I think it poses a question, buy time for what? Really, everyone needs to understand that, yes, we can buy time, we can stretch the cash flows, but the end game needs to be focused on, can your business, through buying time, effectively get to a position where at some future state can generate sufficient cash flow to then pay off those liabilities that will spool up over the time that you are in fact buying.
Yeah, and we've got a slide to that we should talk to that certainly. Yeah. The next slide talks to these things called standstill agreements, and standstill agreements traditionally have been used between borrowers and banks, where borrowers have sought and banks have agreed to provide a moratorium of sorts on the banking facilities. They might be called deeds of forbearance, but they've spread more broadly now, so it's not just banks that will provide standstill agreements, but also major suppliers, potentially landlords, and ultimately statutory creditors. Really important aspects or things to consider when you're contemplating standstill agreements with your key suppliers. They can provide an immediate cash flow benefit. However, it's important that the standstill agreements that you seek, that you ask, are both transparent and commercial. There's no point asking for what you won't get. And it's important to go back to some of Tony's earlier comments to make sure that when you're seeking standstill support from your key stakeholders, that there's science behind it. And so if we want these key suppliers to support our request, there's got to be a compelling reason for it. There's got to be a way forward, and it's got to be based on a level of science. As you're preparing a standstill agreement, always think about what's plan B. Standstill agreements will cover our major stakeholders, our banks, statutory creditors, landlords, key suppliers. If we don't get their support, what does plan B look like? So always have a think about, is my standstill agreement, is my request too optimistic? If it's not too optimistic, what does plan B look like? Tony, did you want to talk to the next slide, which is sources of capital?
Sure. So sources of capital. Once the cash flow is built, as we mentioned, it's a very important decision-making tool. To the extent that there is a deficiency that needs to be filled, one of the ways to fill it, as opposed to, or it could be debt, but also equity. So reaching out into the market and either increasing your debt facilities or getting shareholders to put more money in. And the use of a cash flow is an important decision-making tool to understand what are the cost-benefit way up of potentially investing more capital in the business. So things to understand, collateral available to support additional finance. If you are having discussions with your bank, and one of the questions that I have received is, should we go into overdraft while we wait for the government stimulus package to kick in? Really, that might sound like a simple question, but lots of variables to consider in answering that question.
Tony, can I jump in there, Tony? I had a real life example just recently of a business which sought an $8 million facility from its bank. It was an existing relationship, but they needed $8 million to pay some key suppliers. And the question which I put to the director was, if we borrow $8 million, or if we draw down $8 million on our facilities, we are putting at risk the family home and the beach house. And it's probably something that you need to have a conversation with your husband or wife about. And so what this director hadn't thought about was, if I can draw down the $8 million and pay these suppliers, I really need to be thinking about the underlying viability of this business. The last thing I want to do is to pay $8 million to suppliers, find out that the business doesn't have a future, and realise out of this that by using the bank's facilities, which have secured my home and my beach house, that I have in fact lost my home and my beach house. So it's a complex issue, but to me it's a threshold issue. Can the business survive whatever the other side might look like?
And look, they're important considerations, absolutely. In terms of understanding the collateral that might also be available within the business, invoice financing or trade finance against stock. Certainly we've been in discussions with a number of trade financiers who are very active in today's market. They have significant funds to put to work and are receptive to look at cases to understand, can they lend against debtors for businesses that are continuing to trade somewhat diligently and somewhat with prosperity in today's trading environment. And so again, they'll need cash flows to help make those decisions. Also, excess assets, we've spoken about that. Now, whilst shareholders can be a source of capital, and as Nick stated, that may have personal implications on offering additional assets for security, professional networks can bring other investors, professional investors to the table, whether that's in the form of private equity, whether that's in the form of family offices, or high net worth individuals. We're having those discussions every day as part of our ordinary business, and not everybody's been impacted equally under this COVID-19 proliferation. What I would say is that capital does still exist to be put to work for opportunities that are understood, and with a pathway towards coming out the other side of this pandemic.
Yep. It's a good segue, Tony, for the next slide. So the next slide, we talk about what does it look like on the other side. And if we've spent some time thinking about what our crisis plan does, what does it require, how will it help us for the next 3 months or 6 months, I touched on before, we need to have one eye on the future. So the questions which we would ask is, how are you going to fund a restart? What does your business need to look like on the other side? Because I think there's general consensus now that the business that was a month ago will look quite different from whatever the business is in 3 months or 6 months' time. The overarching question, what's the longer term viability of your business? And so there's a number of considerations which we've summarised there, but ultimately, if we devote a lot of capital to the next, or to the last month and the next month, 2, 3, 4, 5, 6 months, what capital requirements are we going to need to restart our business? And so to what extent, if we've got capital available today, whether it's overdraft facilities or cash or whatever that might be, to what extent have we got or will we need support from banks? Do we have available security? Are we prepared to put it at risk? Tony touched on it before, there's a number of deferrals which have been discussed ad nauseum over the last couple of weeks. They are deferrals only. So how do you propose to catch up on those deferrals? Because they're not debt forgivenesses, and it's a really important concept. What are we going to do differently? How are we going to identify and action cost-cutting programs? We've got internal inefficiencies. Now's the time we should be thinking about them and developing plans to change our business and to embed the lessons which we've learned. But I think the overarching comment that I'd make is we need to be prepared that the benevolence of the banks and suppliers, governments, landlords and the like, that benevolence is going to come to an end. So what are we going to do to manage our way through that when that arrives? So to the next slide, we pose the question, what if your plan's not working? What if your plan isn't going to get you through 90 days if your runway is going to be shortened? What if you're not going to get out of the coronavirus for whatever the reason might be? We need to recognise that we do have obligations as directors. The insolvent trading regime has been changed. Directors are effectively excused from insolvent trading for the next 6 months. But as we've said on the next slide, and I'm not going to labour it, directors still have their overarching obligations in and around their role as fiduciaries. So they have to act in good faith, they have to exercise proper care and diligence and the like. So whilst insolvent trading may not apply, there's some fundamental issues which still remain. And ultimately, the question is, do I have the stomach to push through this? Do I have the capital to push through this? Am I prepared to put the family home at risk? And so if we're going to make some decisions in and around what the next month or 3 months or 6 months looks like, we need to make sure that we're maintaining proper financial records. With proper financial records, we can prepare some pretty robust forecasting tools, including the cash flows which Tony's talked to, because we want to be making informed decisions at the right time. And so to the next slide, we touch on our options. And whilst the mindset of a director is ordinarily optimistic, I want to push on, I want to get through this. There's some fundamental questions which need to be asked and challenged in and around whether we do in fact push on, or do we use this as an opportunity to bow out gracefully? We won't get another chance like this, I shouldn't have thought, in our professional lives, to bow out gracefully. What does that look like? And how do we benchmark that to the third option, which is really about mothballing your business? So we have 3 options. What are the considerations? Invariably, they're cash-based, working capital-based, excuse me. And each of them have different risks and different implications. So I'd suggest that you use this slide as perhaps an anchor point when you're making decisions around whether we're going to push on, whether we're going to use this as an opportunity to bow out, or whether we're going to mothball our business, or whether we're going to shift between those 3 options over the next few months. Tony?
Yes, so in terms of bowing out, hibernation, use of an administration process, and I think you'll touch on this through the presentation, Nick, can also be a way to deal with creditors and other suppliers in a more formal approach. And so really options and solutions, you're right, this environment presents unique opportunities to do so, and particularly previously formal appointments were viewed very negatively and perhaps with a certain stigma, but in today's environment I think perception is really changing, and they can be used, they were potentially used a good 15 years ago as a restructuring tool to enable an appropriate stabilisation and recapitalisation of business that otherwise is not possible without that formal appointment.
Yeah, and I think it's a good point, Tony. There's some legislation brought in a couple of years ago called Safe Harbour, and it's designed, or it provides a defence to directors from insolvent trading. And whilst that probably doesn't apply today because there's been some legislative amendments in the last couple of weeks, I'd encourage people to use it as a tool for framing their thinking. So how do I benchmark whether I push on? How do I benchmark the risks to insolvent trading or breaches of director duties? But ultimately, what's my plan to get through the next period and be in a strong position to pop out the other side? So if we go to the next page, and I'm mindful of time, if we go to the next page, the concept of hibernation. So hibernation allows us the flexibility to either re-engage at a point in time, or if we decide that we just don't have the working capital, it provides us the chance to bow out gracefully. So it gives us some flexibilities. But ultimately, I think one of the things which I've noticed in the last couple of months is that the negotiation with creditors has been done on the run. There hasn't been enough thinking or rigour and discipline around getting everyone in the one room, metaphorically of course, to understand what cash flow support we as a business need and what concessions we're going to seek and how we might make that up at a point in time. But the challenge that we've got here, of course, is this concept of deferral is not providing the solution of reducing our costs. And this is the opportunity that we have now to reduce our cost base and to right-size our business so that when we do restart, we don't have the same sort of working capital stresses and we have a more profitable business. So if we go over to the next page, we talk about, and I don't want to labour it, but I do want to touch on it, the concept of voluntary administration and using a deed of
we seem to have lost Nick, so I'll take over there. So deed of company arrangements can be put in place with creditors, and effectively what that means is that you can...
Sorry, Brett, can you hear me?
Yes, sorry Nick, go ahead.
So I lost you there. So I think the idea of trying to formalise an agreement between our various stakeholders is particularly important so that we're not trying to develop strategies on the run. We take a deep breath, we work out what our cash generation is, we work out how do we need to hold the fort so that we can be prepared at the other end. Can you still see me?
No, I can't see you, Nick, but can certainly hear you.
Okay. I'm mindful that we're close to 1 o'clock. What I'd like to do is to go to the next slide, which I've called reflections. So what we've tried to do here is to pick up on some of the themes which we've talked to and focus on the things that really matter. We've covered a lot of ground, obviously, but I think that what Tony and I sort of talked about when we prepared this session was really cash is absolutely king. It's all about how do we build a buffer and how do we benchmark a buffer against a cash burn rate, not just for the lockdown period, but also we can't spend all our tickets now and not have the working capital to get us through the restart phase. So to what extent have we got our eye on the cash to get us through, but also to pop out the other side? Cash flow, live it, breathe it, adapt it. It's the single most important tool for this time. And if people haven't got the right cash flow tools, please give us a ring because it's just so critical. I'd also challenge businesses to think about what are truly critical creditors. Have you got a criteria for determining whether a creditor is truly critical? And there's a difference between critical and important. If they're not critical, we just have to push them out. We need to buy time, we need to prepare. The assets that we have, again, are they critical assets or are they surplus? Do we need the cash? We may not need the cash, and if we don't need the cash, that's fine. But we need to adopt a mindset of realism. We need to desist on optimism for the time being. We need to pop through this. Getting to the other side, we want to be in the best position possible to recommence our new lives without significant liabilities. And one of the issues, one of the concerns that I have, I think we're seeing a false dawn at the moment. So my concern is that with this kicking the can down the road mindset, there's going to be a build-up of liabilities so that in 6 months' time, when these stimulus packages come to an end and businesses need to stand on their own 2 feet in the new norm, that I think there's going to be some significant issues. So to the extent that you can, think about ensuring that you're not carrying significant legacy liabilities through to the other side of COVID. We've touched on the concept of creditor deferrals, but I think my overarching comment would be ready. This benevolence will not last. It can't last. It's been a terrific stimulus package for a time, but it'll come around soon enough that the banks and the suppliers, landlords and governments and the like are going to say, we need to get back to running our businesses as we once did. So benevolence has been generous, but that won't last forever. So I think they were the reflections which Tony and I put together, but happy to take questions, whether it's in this forum or whether it's by email afterwards. I suppose the only other comment I'd say is businesses that were strong before the coronavirus should be okay. If businesses have legacy issues, they need to think about how they're going to restructure, how they're going to bow out gracefully, because I suspect they're not going to have this opportunity again to use the coronavirus as an impetus to shift their thinking, change their business and or to bow out. But that's sort of all I had to say, Tony. So perhaps back to you.
No, thank you, Nick. And look, I think you raised some really important points, particularly use of these formal appointments, which if I look at our own experiences, going back a month compared to now, a month ago we were having totally different discussions with clients, really about, well, how long will this impact be on business? How long will it go for? How deep will it be? I think people were taking a bit of a wait and see approach. Now there's a bit more visibility in terms of what the impacts are, and we're now seeing clients really starting to have an eye to the future, because there's more certainty than there was a month ago in terms of what this could look like over time, and therefore more decisions are starting to be made in terms of dealing with these cash flow issues and the options that might be adopted. And so I think we've moved from understanding the problem to now starting to implement strategies in dealing with the problem. Now, whether that means continue to trade, new finance, or hibernation, mothball, there are various options out there. It's not a one-size-fits-all. These are bespoke solutions which are individual to businesses, even within a sector. And so that's the point I would make. Your circumstances are individual and need bespoke advice.
I think there's a couple of other comments which I'd make, Tony. One is we're doing some work with landlords. So the landlord is in fact our client, but what's becoming more and more clear is that the landlords want to see that there's a meaningful plan for the tenant that's seeking the concession. Notwithstanding that there's been a code enacted about a week ago now, the landlords still want to understand the tenant business a whole lot better, because in the past the landlord literally just collected a three-month bond, or whether it's cash or bank supported, and the tenant paid their monthly instalments. In getting through the next 6 months, 12 months and beyond, I think landlords will take a far more sophisticated approach to qualifying and understanding the profile of the tenant. So we've got some modelling which we've done on what the request needs to look like, but the landlords are far more sophisticated. I think also using the lead time for the next few months to get your business ready for what the new dawn looks like. So the concept of business inefficiencies, redesigning a business, we're not going to steal the thunder of our colleagues who are running a seminar or a webinar next week, but I think that's also going to be an important part of the process. How do you build a runway? How do you buy yourself some time so that you can redesign and weed out the inefficiencies in your business? And that's a topic for a BDO seminar. I think it's on the 29th of April, so that would be worth looking at too for those who want to start thinking about that. So, Tony, do you leave it to you to wrap it up, perhaps?
Sure. Thank you, Nick. And so we hope that today's session's been useful and has given you some pointers in terms of understanding what is critical in starting to prepare a plan to move forward through these unusual circumstances that we find ourselves in. Hopefully some of the tools are useful for you and prompt some good thinking. Certainly in dealing with the various stakeholders, you must have a plan in place to maximise your chances of success. And in that respect, we also have a diagnostic tool which we've developed. That's online. We'll send you a link. All participants will receive a link to that business diagnostic tool, which will ask you a range of questions and then prompt and provide some high-level advice for consideration. And by all means, to the extent that you've got queries, please reach out to myself or Nick, and we'd be only too happy to assist you in respect of those.
Well, thank you everyone for joining the session, and we hope you can join us in 10 days' time for the discussion from a couple of our colleagues on building a more efficient model, building a more efficient business model, perhaps looking at the workforce and how do we better prepare ourselves for the other side. So thanks again for joining the session.